Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul discuss the Yale Model. With indefinite investment horizons, endowments typically gravitate towards illiquid investments, such as hedge funds, private equity, and venture capital. Trend following aims to take advantage of human irrationality. Long short allows you to adjust and perhaps stamp out market risk. M&A takes advantage of price jumps when companies get bought out. Venture capital understands that most bets will lose money because the winners will make up for the rest. Unfortunately, smaller investors end up paying 3 to 4% a year in combined fees. Even so, the returns are worth it, right? And now, onto our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So last week we talked about commodities, and Trishul, as the former CTA, which we couldn't quite remember the acronym, we're guessing just a little bit, but we do know the C standard for commodities. What helped us go really deep on how commodities are traded, how they may have fit in an asset allocation in the past, and kind of why we don't use them. And as we continue on this theme of asset allocation strategies, one of the big ones that has existed in both academic and real world research is something called the Yale Model, or it's also called the endowment model. The idea here mainly was these universities have very large endowments, usually on the scale of billions of dollars. They don't necessarily have a time frame because they're not worried about any individual lifetime. It's looking to sustain growth over an indefinite time frame, but also use money consistently to support projects for the school. Could be scholarships, could be other research, but because there was no time frame like there is for individuals saving up for their own financial independence, and they had significantly more dollars available to them, they invested in different strategies, and it's worth discussing that today. So the main difference is the stocks and bonds, so US stocks, international stocks, bonds, make up only about a quarter of their asset allocation. They actually put a lot of money into illiquid investment strategies. Things like real estate, private equity, venture capital, hedge funds. And so today we will kind of talk about some of these also alternative asset classes. So last week we talked about commodities being alternatives, energy like oil, gas, precious metals like gold, silver. I forget, what's the categorization for things like corn and lumber? I forget, it's like natural resources, or I forget the categorization there, but we talked about
I don't know.
those types of alternatives.
Or I don't know. Yeah.
Today we're going to talk about more alternatives that have nothing to do with commodities. So the theory here was, because stocks and bonds are very liquid, it's very easy to buy and sell them. They're kind of fully priced out. There's a lot of volatility. Like, we have all the information we can. So it's similar to the reasoning of why we go passive instead of active, that kind of all the information is out there. And so we get as close to efficient market hypothesis as we can. But if there is an illiquidity, there should be an illiquidity premium. The idea here is similar to a risk premium, where if I'm going to own the risky asset, I expect to be paid more. And this has played out with equities over centuries. So there's a pretty consistent risk premium. If you're willing to take on the risk, you can expect to be paid out more. There's also an illiquidity premium. If you are willing to give up liquidity, and some of these investments might have a 7 to 10 year time frame, if you're willing to give up that liquidity, you can also expect to be paid more. And so we'll kind of touch on each of these. And I know Trish was starting to mention some of the hedge funds in the past and how they might trade on commodities, but they'll use different strategies. So similar to the commodities trading advisor, one of the or a few of the hedge fund strategies that come to mind for me are trend following strategies. There's long short, M&A strategies or merger and acquisition strategies. There also might be risk parity strategies. So we're just kind of like go down our list of other things, quick education on what they are, and then how they may or may not fit in a portfolio. So Trisha, do you want to try and give just a little more education on trend following strategies and kind of the theory behind them?
Yeah, happy to. So when it comes to investing in general, there's only two key questions that you need to kind of figure out, and then you can make all the money in the world. So the first question is, what do you invest in? And the second question is, when do you invest in said thing? So if you know what to invest in at the right times, well, then that's it. You're done. You figured out how to make a perpetual money machine. And when it comes to active management type of strategies, well, they're trying to answer these two questions. And they're looking at these baskets of instruments that move up and down in price. And the way these individuals try to figure out what to buy, there's two key themes that they kind of look for. And I think this covers the vast majority of different types of strategies. The first thing that they try to look for is trends that they think will continue. And that's what trend following is about. And one notion of this trend is this notion of momentum, where things that are going up, for example, tend to keep going up. They have some sort of inertia behind them. And if you can spot these patterns, then hopefully you might be able to make some money. A classical notion of this pattern, I like to say classical, but this is 20 years maybe ago, where this was researched by a good amount by some hedge fund managers and academics going back a few decades. Cliff Asness put out a paper called Value Momentum Everywhere, where he looked at momentum, this trend following type of notion, all over the place. And he noticed also academically and empirically that this notion may have existed for hundreds of years. The notion that if something's doing well, it gets a lot of attention and it tends to do better because there's this pile-on effect. So again, his classical definition was if something's been going up for the last year, maybe it'll go up for one more month. So, buy those things. And if something's been going down for the past year, maybe it'll go down for one more month. So short those things. And, these types of trend following strategies underlie a lot of the strategies in the hedge fund space and a lot of the strategies in the CTA space, which we mentioned yesterday. So they're definitely a way to think about things. And it's, one way to think about how things are going to move. If they're going up, they tend to go up. If they're going down, they tend to go down.
Would you say, would it be fair to say that these are kind of taking advantage of the irrationality and randomness of investors? The idea that while we have no idea what the stock market's going to do, psychology and behavior of investors is just a little more predictable, where because it has been going down, people are a little more fearful and more likely to try and get out, and they'll keep selling out. Kind of like you said, it's been going down for a year, might go down for the next month, as others are reacting to what it has done.
Right. So the line of reasoning kind of goes like this. They might say, okay, phase zero, yeah, we get it. The market's a highly random, and you might not be able to use past information to make future predictions, and the past performance is not predictive of future returns and whatnot. And then there's another line of thinking that's saying, but wait, you have humans participating in this space there, and we know humans aren't always rational, and we know there have been plenty of time periods where humans have acted in group fashion to move market prices beyond the level that's sensible according to what they might be worth from a purely rational economic standpoint. The pile-in effect we've seen, for example, with Bitcoin and other types of similar instruments, where we've seen a large flow from a speculation standpoint that's driven up the prices beyond what one might consider sensible. So there is this notion that a lot of people may be buying Bitcoin because it's in the news and they're hearing about it, and that's causing it to go up more, and then more people see it, causing it to go up more and more. And yeah, that's a notion that could be backed by human behavior.
Okay. Anything else you want to follow up with a trend following strategy, or should we move on to the next one?
Well, so there's a cousin to trend following, meaning instead of things always, going with the trend, then the other notion is this notion of reversion, meaning if a trend has gone on too long, maybe it's going to revert. And one way to think about this is it's kind of against the grain. It's a little bit of a contrarian notion. And the notion here is, well, if something's overshot, then isn't it going to go back to its supposed mean? Isn't it going to revert back to where it should be? And that's where the mean reversionists come into play, saying they look for these kind of counter trends, the notion that something's either overshot on the upside or overshot on the downside. And, frankly, I'd say almost all investing can have links back to this type of understanding, whatever it happens to be. The notion that things might go up because they keep going up, following a trend, or the other side of the bucket are there two sides to a bucket? Probably not.
Other side of the coin.
The other side of the coin, or maybe under the bucket. I don't know. I'll drop that one. So yeah, the other side of the.
Sorry. I don't even know what bucket you're. I don't even know where the bucket. I can't even think of. There's a drop in the bucket.
There is a drop in the bucket, but
okay. I don't know what expression you're looking for. I can't quite help you out.
I don't know. Maybe I shouldn't be looking at buckets for. But anyway. So yeah, the other side of the coin is, it's either something that's trend following or something that's probably has some sort of mean reversion component. So you'll see this theme highlighted in a lot of the different things we'll talk about for probably the rest of this episode.
I actually think that that distinction, like the momentum and value, these are kind of have been identified as factors when it comes to investing, and they do seem to be, I don't want to say kind of consistent, but like there's a lot of research that says these things have existed in the past. Because when I think of the value side, like one of my clear indicators, at least my understanding, because I've never been a hedge fund trader, I've never helped my clients participate in them, but it's through more academic research, looking at like a long short strategy. And you'll have to correct me if I get this if I misphrase this, but here we're looking at, say, two companies such as Coke and Pepsi, where we would expect all of the external market environment to affect both of them more or less the same. I'd expect these to be relatively highly correlated in respect to everything else going on in the world. But if I look through the financials of each individual company and say, okay, Coca-Cola is just a little bit healthier of a financial company than Pepsi. And so over the next year, 5 years, over my next time frame, I would expect Coke to outperform Pepsi just a little bit. I don't know if they're both going down. I don't know if they're both going up because I don't know what's going on in the rest of the world. But however they do, I think Coke will do a little better. So I think this is kind of a more fundamental analysis where you're looking at the financials of the company. This would be like related to the value that you look for. But now I'm going to go long Coke and short Pepsi. where if they both go down exactly the same, I'm still neutral. Haven't made anything. If they both go up exactly the same, I'm still neutral because my long offsets my short. But if my prediction is correct that Coca-Cola does outperform Pepsi, then I will make money in a down market or an up market as long as Coke outperforms Pepsi. So because I'm long Coke, even if Coke goes down, if Pepsi goes down more, my short side on Pepsi has made up for anything I've lost on the long side. And if both of them go up, if Coke goes up more than Pepsi goes up, my long position in Coke has outweighed my short position in Pepsi. And that'd be an example of a long short strategy where you can remove a lot of the outside factors or a lot of the outside economic conditions, and you go long short of two similar asset classes or two similar investments, and all you need is your long position to outperform your short position. Is that a good summary of a long short strategy within a hedge fund?
Yeah, so what's happening with the long short is there's this notion of gearing in the market, meaning how much risk are you taking and what different types of risk are you taking. So if you're just invested in the market itself, you get something known as the market return and the market level of risk. So mathematically, we call this a beta 1. You basically get the movement of the market. And you're diversified because you're investing in all of these different instruments, and the average return of all these instruments is the market. And what that entails is you're basically making a position that on average, all of the stocks will go up. You don't know which ones will go up or down, but on average, they'll go up and you'll get that average return. So that's something you might get if you just went long the S&P, 100% invested in the S&P. However, if you wanted less risk, you could take out some of that market risk by shorting the S&P or leaving some money in cash. Right? There's two ways to go about it. You could go 100% long the S&P and then short 50%, or you could just go long 50% the S&P. Now, why would you just go long the S&P 100% and then short half of it? Well, you wouldn't, but this will make sense in just a minute. But my point is you can change the amount of market risk you're taking, and you can even go above 100, meaning you can borrow money and go 2 times the S&P. Or you could go all the way down to 0, meaning you can go long the S&P 100% and then short the S&P 100%. Now, you'll be left with 0, so you won't do that actually. What you might do, though, is you might go long a certain subset of instruments within the S&P that you think will do better than the S&P, and then you'll short the S&P. Or you might go long a specific subset of instruments in the S&P that you think will do better than the S&P, and then you short another specific subset in the same amount of dollars that you think will do worse than the S&P. So now you have a long-short portfolio that's long 100% and short 100%, but your market risk has been squashed down to 0. And what you're taking on is something known as idiosyncratic risk, the risk of these different companies moving orthogonal to the market in different directions to the market. So you can gear your market return to whatever you want it to be, 0, 100, 150, even negative. And you can gear how much of this idiosyncratic risk you want that's kind of against the market. So that with the long short strategy, typically what you would do is you would stamp out that market risk. So you would be long X and short negative X. Oh, no, short X. Well, anyway, long $100 and short $100 of something else. And hopefully the things that you are long do better than the things you are short.
I like that. That's I think my strategy fits, but that's a much better detailed technical explanation. So thank you for that. I think similar to that, I don't know if you consider a subset of long short, but when I look at M&A strategies, the mergers and acquisitions, if you look at when one company announces they're going to buy another company, the price of the company being bought almost always shoots up. And the company who's doing the buying will usually come down a little bit. The idea is that the buying company is putting money towards that other company, so it kind of affects their financials a little bit. And the company they're buying, they're almost always like agreeing on a price that's above the current market price. That's how they're going to entice all of the shareholders to actually sell. So they announced, we're going to buy this company at $50. And the stock was trading at, say, 40. So it jumps up 25%, but it actually doesn't jump up all the way. It jumps up, but there's a little gap there. It might jump up to, say, $49.50 or $49.75. And an M&A strategy is, I think there's one was buying that acquired company at the $49.50, waiting for it to be bought for $50. So like you kind of the likelihood that deal goes through, you're going to make 50 cents on that deal or a quarter per share on that deal, because that gap still exists because there's still a possibility that the deal falls through. There's still a possibility that the company doesn't buy it. And now the stock probably goes from that $49.75 back down to about the 40 it was trading at before. So if that was the baseline, it'll go back down to that level. So you're kind of making a probability play of a high probability of making a quarter versus the very low probability of a 20% loss. And this is usually referred to as, I think it's picking up pennies or picking up nickels in front of a steamroller, where the steamroller is rolling really, really slow. So you can kind of keep gathering these nickels and coins until you get caught, and then the result is catastrophic. I think the other form of M&A was, I think, trying to either predict or influence which companies might buy out other companies. So now if you can figure out which company is going to be the buyer and which company is going to be bought, you could either go long the company that's going to be acquired, or you can go short the company that's going to be bought, or the combination of the two. So now you're benefiting from those kind of, if after the deal is announced, they're predictable dynamics, but if you can pick the two companies before the deal is announced, then you could benefit from that. I think sometimes if you have a large enough position in some of these companies, you can actually use that to influence some of the corporate decisions, where if you have enough of the shares outstanding to influence the voting of the corporate decisions, you can also start to make money through this M&A strategy. But I think I described like three things there that all kind of lumped in with M&A. When you think of mergers and acquisitions, what do you think of in terms of like how hedge funds will try and make money?
Yeah, it does come down to that prediction standpoint. So there's a good amount of modeling that goes on here, where individuals try to understand, what is the value of a company versus what's the value of a company if that company acquires X, and then you just change X through the whole alphabet of other companies that it might acquire. And what investors look for who are looking at these types of strategies is this notion of synergies. It was kind of the buzzword of 20 years ago, where in the M&A space, that what the iBankers tried to push is, if you combine your company with another company, you get something that's better than the sum of the parts. You don't need two divisions to do the same overlap of work. You can accomplish more with less, and so on. And that was kind of the big push for these mergers to happen in the first place. In addition, there was a good amount of consolidation in many industries where, it made sense to, instead of having all these little regional banks everywhere, well, everything's internet and cloud-based, why not just gobble up all the little banks, acquire their customers, and have megalithic banks? So, there's been a lot of industries that have gone through that type of secular change of just getting bigger and bigger companies and gobbling up the smaller ones along the way. So the M&A space has from the company standpoint, seeing a lot of transitions. And then from the investment standpoint, the notion is, yeah, if you can anticipate these types of changes, you could potentially make some money by either, like you said, being more passive and just getting in and out at the right times, or being a more active, being an activist investor, being actually more hands on how that actual transition happens, how that actual acquisition happens. And so that's what's kind of happened in this space. One thing I probably want to say is there's been a good amount of research that's come out after these big bursts of acquisitions and mergers that has kind of shown that the synergies that were kind of looked for in all of these cases haven't actually panned out. So a good amount of the times a bigger company goes into gobbling up a smaller company, their goal is, yeah, they might take a hit early on, but over time they want to get bigger than they should otherwise, right? Why would they do that if it's not going to be beneficial by some means? But it actually turns out that those synergies that were looked after, which is supposed to overcome that premium that they're paying for those other companies that they're gobbling up, a good amount of the time, I think what the research said is 80 to 85% of the time, the actual acquisition didn't turn out to be as synergistic as they had anticipated.
So I guess, do you see any M&A strategies still around, or they've was that something that was phased out?
They come in cycles. They have their space, so I don't think it's going away. There are periods, depending on the industry, where it does make sense for M&A to pick up. There could be a period where, as I've said, there's secular changes that just tend to happen, like a consolidation of broadband internet companies or regional banks or different retail type of enterprises and whatnot.
Yeah.
However, there are other time periods where that maybe a certain industry becomes distressed, and that's a period where you could have these types of situations. Now that there's also this whole distress side of the equation in terms of lending and buyouts. So that's kind of like a forced merger where you're kind of sunk down and you need to find some sort of candidate to come in and refix up things and change up your business, because either you have too much debt or not enough equity or cash flow supporting that debt. So you need an infusion. And this is where like a leverage buyout may come into play.
Okay. What's another hedge fund strategy that you've seen?
So to kind of recap what we've covered like the trend following and the mean reversion type of strategies. And again, these might be known as value and momentum. And then we talked about this gearing notion where you can also decide on how long or how neutral to the market you want to be. So that's either, long only, just long, and making picks that still have a good amount of market forces behind it, or long short.
Yeah, I've also heard that's the gearing. Market neutral is another phrasing for the strategy there.
Yeah. So with market neutral, you're long short, and then also you might be sector neutral, meaning within your picks for the S&P 500, you would still have a proportional weight to transportation, healthcare, financials, technology, as would be represented in the market. However, within the technology sector, you would be long the good technology stocks and short the bad technology stocks. So you would be more neutral to whether tech does good or bad overall, but more favorable on picking within the technology space and every other sector, which stocks end up doing better.
Okay.
So,
anything else you want to add on that, or?
Well, I'm the high level themes I'm kind of thinking are, first is, again, this notion of mean reversion and trend following. And I think in the long only space, you see a lot of value players. So that's probably what like Warren Buffett would be categorized on. So the trend players tend to be on a shorter time frame, and they're looking for trends that might pop up and could go away, but just riding the waves when they exist. And then the value players might be looking on a longer time frame. So a classical quantitative definition of value is you might look at 5 years and say, if something's down for the past 5 years, then I'm going to go long, I'm going to buy it for the next 6 months. Or if something's been going up for the past 5 years, I'm going to, short it for the next 6 months. So that'd be like a reversion play on value. But, like a Warren Buffett type of value is he wants to find companies that he thinks are great, but at a low price and hold them forever.
Yeah.
So that might be a standard long only play.
Okay. So I think when I think the next category within the Yale model, I think it comes back to that illiquidity premium. This would be things like private equity and venture capital, where you are investing in companies that are not yet public. And the I don't want to say strategy because there's a lot of different types of strategy, but one of the ideas is that a lot of these companies are likely to fail. That you trying to predict which companies can go public that are not yet public is very difficult. Many of these companies just don't work out. But the ones that do pay off huge. If you can get shares in a company at $3 per share and then it IPOs, you could see IPO payoffs on the scale of $50 to $200. And I'm thinking just a few examples in the last few years, especially in the tech space. And so a venture capitalist or private equity firm will look to invest in these companies. This is the seed funding or different series funding at different valuations. But they'll do it for enough different companies that they just need one of their 10 to 20 investments to pay off for it to really fund everything else. But this is kind of almost like classic networking because there's no public market. You can't just log into E-Trade and click buy, or you have to actually go find these companies. And there's the kind of classic back and forth and networking between different founders looking for funding and different venture capitalists looking to fund startups, and kind of goes back and forth. And that's why there is a kind of synergy within Silicon Valley, I guess I'd say. Like once you have these founders looking for funding and funders looking for founders kind of in the same area, you start getting some of those networking effects. Anything you think about when it comes to private equity or venture capital, either how it fits in the Yale model or some of the benefits, or even are the costs worth it?
Right. So I think that when you think about this space, you're right. Your one key play is this illiquidity notion. The fact that it's not something that's on an exchange where you can buy it and sell it and buy it again, 100 times over the next week or two. But it's something where you want to make a long-term sensible play. And there's a few ways to go about it. One is somebody comes, to proposition you and saying, hey, I got this great business and it's doing well, and here's a bunch of numbers, and if you invest, you can get in on the ground floor, and and so on. And the second is you can put your money with a private equity or venture capital company where you give them money, and their job is to go out and do these and find these great ideas and put your money to work. So it can be like the one-off, or it can be through another company. Now that there's caveats, or there's concerns with both. The upside we kind of know, but you're getting this illiquidity premium, you're getting this opportunity to get in ventures that are less well known. But the trade-off is, well, if it's a one-off, the big question is, how do you know if you're getting in at a good price? what if they say it's $5, but hey, you can get in at $4? What does that even mean? Like, how does that tie into what your potential will be? And how do his neighbor didn't get in at $2, right?
Yeah.
So you have to be pretty sophisticated, I'd say, to get into these, because you got to know everything about these companies, and you got to understand whether the price you're getting is sensible. Hopefully you have somebody on your end to help you wade through, this notion. And what I'd say is it's pretty tricky, because one of the things that I like to lean on is you really shouldn't invest in something that you don't fully understand. And if you're a professional in one industry and somebody comes up to you, you're you're in the technology industry, you're a programmer, and somebody comes up to you with this new medical device. Well, you got to know a good amount to see if that makes sense, as a business venture. And somehow you have to figure out if that price is sensible. The business could be awesome. Everything they could be saying could make sense. But if you're paying double what it's worth, well, there goes half your returns. So there's a lot to think about if you're going to do it as a one-off. And then if you're going to do it through another company, well, the concern here is, okay, so you're paying another company. That company is going to go find these other companies, and they're going to take a slice of the profit. And hopefully you're left with, more than, or hopefully you're left with your fair share, frankly. And the question there is, are there enough mouths to feed so that you still get what you want or what you expect, and then some, to make this whole idea worth it? What that kind of makes me think about is this notion of hedge funds and then hedge fund of funds. So in the hedge fund space, you have the ability to scout out your hedge fund that you like and do all the research and realize, oh, this is a great fund. They must be doing something awesome because I fully understand it. Or you could say, hey, that's too hard. Let me pay somebody. Let me pay this other fund to find the best funds out there, and they'll figure it out. But then now you're paying the hedge funds, fund of funds, who are paying the hedge funds who are taking their own fees. And it turns out once you add 2 or 3 levels of fees, the return that the average investor gets pummeled. And it turns out to be a pretty bad idea. So I'd say watch out for that if you're investing with a PE firm. There's one extra level of mouths to feed, and that they like to eat well.
Yeah. At my former firm, we had done some due diligence on a few of the private equity firms that were trying to reach out to retail investors just as a way for them to raise more capital to invest. And once you account for, again, the hedge fund or the private equity fund that's going to put together the investment companies, they're charging 2 plus 20. So it's 2% per year plus 20% of profits. Sometimes it might come down like 1.5 plus 20. But then like I said, that fund of funds is also adding another 1+% of fees. And some of these were like the fees were on the scale of 3 to 4.5%. And so now it's thinking, okay, to outperform just the S&P 500, they need to be getting 14 to 16% per year, which some of them have, but it's kind of harder to look at these strategies and say, one, the liquidity pays off more than these huge fees. Two, the economic environment that they're outpacing the S&P 500. Well, if you look at the S&P 500 for the last few years, these private equity firms have to outperform even more. Like the large cap space itself has done so well. For these to outperform and make up for their fees becomes even more difficult. And then trying to get research or data on the funds themselves or the fund of funds is also very difficult, because there's a huge problem with survivor bias, where even if you take a look at all the hedge funds that are around and see what's their track record, that data set kind of by definition doesn't include the hedge funds that started 20 years ago and failed after 10. Either they're no longer around or because they lost all the money, or they did so poorly that all their investors pulled their money out. And so it's kind of this super opaqueness where you don't know how good the medical device technology is because you're not an expert in medical devices. You don't know what that potential market could be because you don't know how big this market could be. You don't know if hospitals can buy it. You don't know if it can get through regulations. So it's hard to judge the technology, hard to judge the business side of it. It's hard to judge your price. So is $5 a fair price versus $2 versus $7? Because again, there's no market for it, so you can't go out and compare it to anything else. Then you start adding in that fund of funds, kind of like, okay, now we're adding in a layer of fees, and we don't know how well. So we don't know how well the venture capital firm can do in making these bets. Because again, the survivorship bias. We don't know how well our fund of fund manager can go out and pick the right venture capitalists or right PE firms. And we're going to add in a 3.5% fee on top of all of that.
Yikes.
It's one of those things where we've seen it pay off so big, and there's enough kind of headline news that you can find the successes. And I have clients who are engineers. They earn a salary, they get some equity compensation, and their company goes public, and so they're benefiting. They're seeing the big payoff. I also have clients who are on their third tech company and have put money into their private company stock, and they expect to just never get it back. This is money like that's probably not going to pay off. And so they're doing okay because they're making their salary, saving their 401k, and taking care of other things. But to choose these as their investments, to go out and find these other companies, it's you don't read about the failures. You don't read about the companies that don't pay off, and you have no idea how to measure these scales. I think that's probably the big thing that concerns me with a lot of these.
Yeah, I agree. I think the distinction that you made is often you might end up with PE because it happens to be from your employer or a place that you worked in before, and that's a different story because you know more about that business. So hopefully you can make a more informed decision. You kind of know the ins and outs, hopefully, of what's going on with the actual enterprise where you have been either awarded the shares or the stock and you've decided to exercise. So in those cases, it might be a little different than a proposition from somebody or a PE firm that's doing business in a completely different area. And again, if you really don't have a good expertise in what's going on there, it's going to be tough. And even if you understand the business, understanding the valuation metrics that are sensible to come up with a price is also a different story. And it's a big part of the equation.
Yeah, it's every time I've looked at these, they're always kind of promising better risk-adjusted returns. That's anyone selling these types of investments is always looking for this, better risk-adjusted returns. And like it's kind of hard to quite tell. Is your return is less than the S&P 500, but are you getting 80% of the equity return for 40% of the risk? Because that does sound appealing. Or are you getting 80% of the return for 80% of the risk, which is just like putting 20% of your portfolio in cash? Oh, and so sometimes it's kind of hard to distinguish. And then it's also, okay, yes, this strategy has worked in the past, but that was before the distributor added their layer of fees. Like, is this going to work again in the future? And I always keep coming back to, okay, but can I accomplish the same thing by just moving from an 80%, 80-20 portfolio to a 60-40 portfolio? Could I just add bonds and accomplish all the same thing without any of the fees or concerns, like the things I can't see, the risks I can't see or measure? And pretty consistently, the vast majority of the time that I've looked at this, if you're looking, okay, we're going to try and get this all stock strategy, we're going to try and get the upside of the market, but we're going to get out at the right time, or we have this other strategy, the vast majority of the time, just moving to a 60-40 portfolio instead of 100% stocks takes care of all the concerns. I just kept seeing it play out over and over and over again.
Right. Yeah. I mean, at a high level, you would think that if anybody has figured out how to outsmart the market, it would be institutions, because they have access to all the resources. They're investing in all of these different types of exotic asset classes and instruments that we talked about. And you would hope that, or I don't know if you would hope, but you would maybe surmise that, okay, here's how it's done and here's what they're doing. And oh wow, look, they're all doing great. They're outperforming a benchmark. And then looking at the actual research, I kind of scratched my head. Are they even outperforming a 60-40 portfolio with all of that effort?
Yeah, I know a lot of advisors will really kind of emphasize data, like invest in something you can understand, and sometimes just the simplest approach really is most effective for most individuals. But I still look at like we've talked about the direct indexing, and it's definitely not as simple as owning an ETF, but I'm confident in that strategy. One, because the fees are low, and two, I can see how it works. But with some of these other things, it's not worth the extra fees to not see how the strategy plays out.
Yeah, I'd say, that there's a difference between trying to come up with a strategy that takes advantages of different tax environments or situations versus trying to come up with a strategy that's trying to outsmart the market.
That's a great way to phrase it. That's the kind of the things in our control, taxes and fees, or I was like, taxes aren't in our control, but like the tax management, though those are sound investing strategies. This will do better in the future relative to this other thing moving forward is less predictable, if it's at all predictable.
Right. And what I wanted to kind of lean on is, the punchline with the institutions. There's certainly more research that substantiates this, but one thing I've kind of pointed to over time is there was a study that looked at, based upon S&P data and data from CRISP, a stock database, and eVestment Alliance. And these are just data sets that include performance numbers of stocks and mutual funds and institutions. Well, based upon, this was a 10-year period, but they just asked the simple question, what percent of domestic funds, mutual funds, net of fees, underperformed their benchmarks? And the number was 89%. And then they also looked at institutions and they said, okay, now institutions, they're doing the Yale model. They're doing all these fancy zigzagging intro into out of PE, BC, ABC, and whatnot. Maybe they can do better. But, from their standpoint, what it ended up being is, instead of 89% underperforming, 86% underperformed. So, in that case, not too much better than standard, retail investors that are out there.
Yeah. Well, this was a good conversation. It's one of those things where I know, one, I've had to research these in the past. I keep looking for, I don't want to say a better mousetrap, but I'm open to the idea of complexity if it can genuinely improve a client situation. So I don't try to be like, oh, this isn't an ETF model, I'm going to ignore it. But I keep coming back to the same overarching philosophy. I think that's part of the reason why you and I get along so well.
Yeah, I certainly agree. It's, as you said, a couple minutes ago, focus on the things that you can understand and control.
Yeah. Well, thank you for the conversation today, Trishul. I really enjoyed this one.
Thanks, Aaron. I enjoyed it as well. And thanks, everybody, for listening. If you like these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.